Yes, good afternoon, all of you. I just want to conduct today's discussion, taking into account the things which we have already discussed in earlier sessions with regard to the stock valuation. Then we went through the different aspects of portfolio performance evaluations and the term structure of interest rates. Those are the three topics which we have discussed in recently held sessions. Even though we did that, we have not gone into the practical aspects of those things. I think the most important thing is to see how it is being practically applied. So therefore, today I just focused on the practical applications of those things, getting access to different websites while I am doing the lecture. So I think you will be in a position to just get a good idea about these different websites where we can access. And those practical things are very much important than the things available in books. As it is, now you all understand, not only in Sri Lanka, the global situation is also in many countries, the inflation expectations are very much on the rise of inflation. Everywhere in many countries in the world, they expect the inflation to go up in the near future. So that is what you call the inflation expectations. Even in Sri Lanka, those expectations are very high. In real terms also, inflation has doubled. And now it really records 14% level. I think about a year back, it was in 9 or 9.8 type of a level. So that means now it has drastically increased. So in that scenario, the monetary policy framework in Sri Lanka, even though that policy interest rate increase was not adequate, they got a step towards the proper direction. On 22nd of January, the policy rate's been increased by 50 basis points. Now it stood at now 6.5 for the stand-in lending facility rate, 5.5 for the stand-in deposit facility rate. So those are called the policy rates. Not only that, there's another two things which could be included in the policy rates. That is the bank rate, that is 9.5, and the statutory reserve requirement, that is 4% now. So I think you all know about all these things. The inflation expectations and the policy rates have a direct relationship, because the policy rates normally follow that trajectory. So therefore, the central bank, the monetary policy department, they have a big focus on interest rates through the inflation expectations. They do surveys on inflation expectations through the financial and non-financial institutions or different investors, so that they do a survey. Every year, they do a survey on the inflation expectations. Through those expectations, through the survey, they can find how the expectations go. So that is a factor they would look into when they decide on the policy interest rates. So these are the things which we need to understand. So therefore, I really want you to just go through those websites, and I need to just show you how we can get the full use of such things where you can get a good idea about it. And before that, I can just give the theoretical background on those things. As I told you, the term structure of interest rates. In other words, we call it the market interest rate. Market interest rate is a combination of real rate, inflation expectations. Then you have the risk premium. Those are the things which we can take into account when you have an idea about term structure of interest rates. Now, when you talk in terms of risk premium, there you have different risk premiums. The liquidity risk premium is there, credit risk premium is there, some other risk or market or whatever it is. Those risk premiums also will be added there. So it is a collection of all risk premium when you say risk premium. And I think there's another concept called the spread. The spread also depends on those risks. So therefore, when you do an investment, you need to just look at the risk profile of that particular investment. And you can see whether the rate quoted for such investments are fair enough. It is fair when you just look at it in the market perspectives. So these are the theoretical aspects of those things. And if you go into the lesson first,
Sir,
yeah,
last week I couldn't come to the class,
yeah,
so I was waiting for the online material to go through, but
yeah,
I didn't get it. Today morning only they have uploaded it to the web. So after working 5 days, on Saturday we have many chores at home, so we couldn't. I couldn't go through the material because on Saturday morning we can't do anything. So on during the weekdays we can do it on morning or at night. So could you please ask them to
No,
upload?
yeah, I think that the same request was made last week also.
There's
Last week
no
or
point doing
week
online.
before the last. But anyway, now I just informed them. But only issue is this now. I think they did the mistake, and even I yesterday I got a message from someone, and then I just told them to upload, and then I think they afterwards they uploaded it. But anyway, what I want to tell you is now, say this is a type of you know now when you couldn't just uh, follow a class or whatever. Now this is the type of additional type of thing which you can get. So therefore, anyway, I really asked them to do it in time, but in time to come. But anyway, now this is really a type of a thing where you can uh, just rely on, but there can be situations where they were not in a position to put in on the same day. But anyway, so I have just told them, and you see that is why they just uploaded it today. But anyway, so this particular thing I don't have any idea of. I think your matter is now, when if you couldn't follow the things, then it is really a problem of you. But anyway, as a normal courtesy or whatever, they are in a position to just put those things. I think it may not be a compulsory type of a thing. So that's what I want to tell you. Anyway, it's okay now, because the thing is now, any type of a course now, if when it is being conducted, now if a person is not in a position to follow a particular lecture also, then the particular uh, issue or the particular disadvantage would be with that person. So that would be there. So So therefore, I don't think that it's a type of critical thing. I don't know. So anyway, they will do it. They will do it, but it may not be a certain type of thing where they have to do, but they will do it in time to come. So anyway, so the matter is now, if you can go through the things, the lessons or whatever, and you can get an idea, then there's no big issue here. So what I feel is that. So then you can do that way. Anyway, now in time to come, there won't be any issues. They might put it during the week. And if someone is unable to attend the lecture, and he might be in a position to follow it, so they can do it. But it may not be a compulsory type of thing, in my opinion, because the thing is, now when a lecture is conducted, so if you don't engage in that lecture, you will be at a great disadvantage, because you can't really have a recording of it and follow it and get the same thing again. So that is the way. So therefore, the main thing is, you should really focus on the lecture as and when it is being conducted. So then you will get the full benefit of it. So that's the other one is a type of mitigation only. So therefore, I think in time to come, you really concern about the participating in the lecture. So if you are unable to participate in the lecture, then you have to go for that mitigation. So that is the thing which you need to understand. Anyway, I think I just told them again and again, but they might do it. But what I feel is, we should not, I mean, find fault with them to say that so it has to be a compulsory thing or whatever it is. So my feeling is that. So there's a certain compulsion here to participate in the lecture. Then and there you can clearly discuss with the lecturer and I mean, sort out the issues. But rather, if you fail to do that, then that is the type of mitigation or whatever, the availability of the recorded lecture. Because if you are really, I mean, say, rely on that recordings, then you might have a tendency to just forget the lecture, and you may not participate in the lecture online. So that is the issue. So therefore, I really tell you, anyway, no, there's no issue. I mean, they will do it in time to come. So then, but I think in your side also, you should make it a point to follow the lecture on time.
Thank you, sir. Thank you.
Right. Now, as it is now, we have just gone through this lesson last time. And there you have the different evaluation criteria. Net asset value per share as an indicator of performance. Then you have the one period rate of return, geometric mean return as a measure of return, and Sharpe's index and the Trainer's index. And those were the things which we have already discussed. And finally, we discussed about the future investment value as a measure of evaluation. So those were the things which we discussed under the performance evaluation of portfolios. So finally, we talked about this future investment value, and it's a very important type of a model, and that model gives you a benefit, the real benefit, and that benefit really you can project certain returns of investments for, say, substantially a longer period, say 10 years, 15 years or so, you can just project. So therefore, we can consider this measure as a good model or reasonable model to do these projections. But only problem is now we have to see how we can apply these things into different situations. But all situations are not, you may not be in a position to apply this particular model to every situation, but you have to find out, or you have to select the situations where the compatibility is there. The compatibility is checked through the environment or the types of conditions which should be fulfilled. Now, as it is, this model can only be used when the returns of investments distributed in a log normal distribution. So that is one assumption. The other assumption is the trends in the past should prevail in the future also. So that is the next assumption. If you can have those assumptions at least in an approximate manner, you would be in a position to apply this model. So therefore, it is very much important for you to check whether the environment is compatible with the model. If it is not, you are not in a position to apply the model. Even if you apply the model also, you would not be in a position to get the valid results. So that is the issue. So therefore, in order to apply this model, you should be certain, you should become certain that the relevant conditions should be fulfilled. So I have now told you the most important conditions to be applied here in order to apply this model. And the other thing is, now we have two ways of using this model. The one way is to see what is the probability of having, say, twofold or threefold or whatever, what you have already invested. Say, for example, you invested 100 million, then how would it become 200 million? In which time, or how long would it take to grow it to twice, or grow it to 3 times, grow it to 4 times, likewise. So that type of projection we can make. So we can get the probability of having it. So then the next thing is, we can see the probability of losing from the investment during a period of time. So these are the two things which we can project. But the projection you get only have a probability. So the meaning is you would not get it in an exact means. You would get it as a probability. So for example, say you can get a particular answer to, say, within 5 years, what is the probability of doubling the investment? So such type of a projection could be made. So if the probability is 95, 97 or whatever, then you can be certain about it. So that's the type of idea you can get through this type of model. So therefore, it could not be an exact answer. Therefore, there's a chance of unsuccess also. It would not be successful in that case. For example, now, if the model says that there's a 95% chance of doubling the investment in 5 years, so that could be an answer. But it could say that there's a 5% chance of not having it. It would not be doubled. So that there's a 5% chance for that. So that is the issue. So therefore, you have to be careful about that. So then, if you get an answer for something, like the probability comes as say 60%, 50% or so, then you need to take a decision. Because when you say 60% or 50%, there would be a chance of unsuccess at 50% or 40%. No? So that could be there. So therefore, you have to be careful in that situation. So in that case, you have to reject such type of an investment. Because if you get an answer which is higher than 95 only, then you can be pretty sure that it would happen. So these type of things you need to take into account. And when you say a loss also, now when you just project the losses, what we do is we just take the investment as it is, because that is the starting point of the loss or the break-even point. So therefore, if you apply that condition, you would get the probability of losing from the investment during a particular period. So that is the next point what we can make through the model. Right. So then we went into the other one, that is the term structure of interest rates. Now, can you see the lesson 7 now on the board, on the screen? Is it seen on the screen? The lesson 7?
Yes, sir.
Right. So the level of market interest rates we discussed in that lesson. There you had 3 theories with regard to the term structure of interest rates: the expectations hypothesis, liquidity premium hypothesis, and the segmentation hypothesis. These are the 3 theories on which the term structure is dependent. And we have focused our attention on the expectations hypothesis. And there we did several calculations. And I think you need to be familiar with the power calculations in that basis. So we did the calculation of forward rates, calculation of YTMs and all that through this expectation hypothesis. And finally, we just talked on the expectation of inflation and all that. So those are very important. So I will just show you a particular policy statement made by the Central Bank of Sri Lanka in this type of interest rate expectations. So I will just show it you now. That is the press release made on 22nd of January. Can you see it on the screen? Can you see the press release on the screen?
Yes.
Right. Right. Now, this is the Monetary Policy Review number 1, January 2022. Right. So, my intention is to give you an understanding about the monetary policy implications on interest rates. That is my idea. That is why I am just giving you these policy reviews and the press releases and all those things. Not only the Sri Lankan things, I will just give you some international things also here. But you have to be careful when you just read it. I'm not going to read everything here, but what I want to tell you is I want to just focus on certain things. Now, I want to just focus your attention on monetary and other policy measures are expected to strengthen the macroeconomic stability. Now, this is the most important thing. Now, in order to strengthen the macroeconomy or the macroeconomic stability, the central bank has decided these things. But there's a question whether these measures are adequate to address the issue of this weakness of the macroeconomic stability or whatever. That is the issue. So then that is up to you to decide or up to you to give points on this. So I will just discuss about it. In consideration of the current and expected macroeconomic development, the Monetary Board of the Central Bank of Sri Lanka, at its meeting held on 19 January 2022, decided to adopt several policy measures with the view to strengthening macroeconomic stability. Accordingly, the Monetary Board decided to increase the stand-in deposit facility rate and the stand-in lending facility rate of the central bank by 50 basis points each to 5.5% and 6.5% respectively. So the meaning is the stand-in deposit facility rate has become from 5 to 5.5 and stand-in lending facility rate from 6 to 6.5. So the increase is 50 basis points. So other things I am not going to discuss, but I just want to tell you the implication of interest rates. Now, the monetary decision has been, it is given in the bottom also. Now, in addition to these two rates, there are two other things which are included in the monetary policy decision. So that is the bank rate. So that is adjusted with SLFR always. So it is 9.5. It is 9.5. I think it has been deducted to reduced to a low amount for a couple of months earlier, but now it has come to 9.5. The statutory reserve ratio also now come to 4%, and it was at 2% earlier. Now these are the things where you need to take into account when you have some. If you want to have an idea about the movement of interest rates in time to come, so you can get a very good idea through these policy statements. Not only that, there's another thing called open market operations and the treasury bill and treasury bond rates. Now you all know, for the time being, the banks, their fixed deposit rates are in the range of 6 to 6.5, 6 to 7 more or less. I don't know whether you agree with me. Most of the banks, they pay for their 1 year fixed deposits from 6 to 6.5 most of the time. But just look at the treasury bill rates now. It has gone up to 8. Yeah. Is there any change in the FD rates in the banks? There's no change yet, no? What do you say? Commercial banks or other banks, do they give fixed deposits a higher rate now? They have not yet increased the rates, no? Deposit rates? I don't know now. In what happened in your institution? Have you increased the deposit rates? I don't think. They are not happened yet, no? But just look at the treasury bill rates and all. It has gone up. Pardon?
We can't hear you. I don't know about others.
Oh, is that so? Yes. Any issues with the sound, or can you hear me? Can you hear me, all of you?
Now, yes, we can.
Right. Okay. Right. Now we have been discussing about the interest rates, the policy rates, and there's another thing called OMO. That is what you call open market operations. Now you all know, when the bank wants to get some funds, what they can do is they can go to the repo window and purchase funds. So we call it repo. Or in other words, it's a lending, or it's a borrowing for a bank. So what they do is they go and just give the treasury bills or treasury bonds. On that security, they can get some money. That is the borrowing. And if they want to deposit some money, they can deposit on treasury bills or whatever. So that's what you call, earlier we called them repo and reverse repo. Now we call it stand-in deposit facility and stand-in lending facility. Now, if you do that, then you need to do it with your treasury bills and treasury bonds. If you do not have treasury bills and treasury bonds, you can't go to the repo window and borrow. That is an issue. So therefore, there's another avenue available for these institutions, the financial institutions, to borrow or lend. So that we call the open market operations. Why we call them open market? Because the rates being decided on transactions, because they can bid. The people can bid on that. They can make 3 bids on open market operations. So then with that, there will be another avenue for them to engage in the market activities. Now I think you get the point, because if the market activities are restricted to only the repo and reverse repo activities, or the stand-in deposit facility and stand-in lending facility, there will be restrictions. Because on the other hand, if they go to the normal call money market, if the liquidity is not enough in the market, they would have to pay higher interest rates in the call money market. To mitigate that, this particular operation being introduced, and we call it open market operations. Now, through the open market operations, the central bank can intervene into the market. When the market liquidity is high, what they want is to just blot off that liquidity. So they need to get the money back if the liquidity is higher. So what they do, they issue bonds or whatever, and people pay money and get the bonds. On the other hand, if the liquidity is low, what they do is they purchase, they purchase bills and they give money. Through that, the money will come to the market and the market liquidity will be increased. So that is the mechanism of the open market operations. I will show you that, the open market operations, with regard to the open market operations, I will show you a particular document. So then you can understand what it is. Can you see the text here, open market operations? Yes.
Yes.
Right. Now it is like this. OMO general refer to the buying and selling of financial assets on temporary or permanent basis in the open market in order to expand or contract the amount of money in the interbank money market. So that's what I told you. Because if the authorities, if the central bank thinks that the money market has an excess liquidity, then what they do is they will issue bonds. They will offer bonds for sale. Then what will happen? The institutions will pay money and get the bonds. Now that is the mechanism to bring down the excess liquidity. If the liquidity is not there in the market, if the liquidity is low in the market, what they do is they purchase bonds from the market and they pay money to those institutions and the institutions will get money. Through that, the liquidity can be enhanced. I think you get my point. That is what they do. Under the OMO, IBSL conducts auctions which either injects liquidity to the market or absorbs liquidity from the market, as the case may be, in order to steer the call rate to the required level. So the main idea of doing open market operations is to stabilize the call money rate. If this doesn't happen, if open market operations are not there, what will happen is, if the market liquidity goes down, the call money rates will go up. That will make an imbalance in the call money market. In order to stabilize that, central bank would engage in open market operations. Purchases of securities inject money into the banking system, while sales of securities do the opposite. Now, what do you mean by purchases of securities? Now, I think this is a very important point to note. People sometimes get some confusion with regard to this explanation. So therefore, you need to look at it in a very clear way. Now, just look at it. Purchases of securities inject money into the banking system. Now, when you purchase, what will happen? Purchases of securities. Now, who purchases securities? The central bank or the public debt department. They purchase securities, and when they purchase securities, they pay money to the banking system. So that is why they say purchasers of securities inject money into the banking system, while sales of securities do the opposite. When the central bank wants to sell securities, what will happen? Banks will pay money and get those securities, and that will bring down the liquidity. The CBSL purchases and sells government securities in the open market as defined in the section 91 of the Monetary Law Act. Right, now you can see the point. Now, have you got the meaning there? because this is very important. That is why I'm just I just want to quote from their documents rather than going through a book. Now just look at it. The following are steps that are carried out in conducting OMOs. Just look at it. Forecasting overnight excess deficit liquidity. So that is the type of operation done by the central bank. Forecasting overnight excess or deficit liquidity. So then only they can realize what should they do. If they find excess liquidity in the overnight market, what do they do? Excess liquidity. They will sell government securities. When they sell government securities, banks will buy that. And to buy that, banks will have to pay money. The money will go to the central bank and the excess liquidity will go down. If there's a deficit in liquidity, what do? They purchase securities from the banks. When they purchase securities from the banks, they pay money to the bank. And that could go to the banking system. Right. Now, if I ask a question, when excess liquidity is there, under open market operations, what would happen? When excess liquidity is there, what would happen under the open market operations? When excess liquidity is there in the market. Yes. Yes, you can answer the question. My question is, if excess liquidity is there, if excess liquidity is there, what would happen? Excess liquidity. Central bank has to sell securities. Very good. Central bank has to sell securities. When they sell securities, what would happen? The banks will have to pay money to the central bank and get the securities. And the central bank will get the money. So they just absorb that excess money from the banking system. I think now it is clear, no? I should not go further on that. So I think that is clear. Right. So I think that part A, forecasting overnight excess and deficit liquidity for that reason. So they forecast what is the situation of liquidity in the market and they do the needful. Then the second thing, participating in daily monetary operating committee meeting to decide whether to conduct auction, if so, its type, quantity and maturity. So this is another thing where they have to do, because they participate in the monetary operating committee meeting to decide whether to conduct auction. Because conduct auction means now when an auction is made, if the market liquidity is high, they can get the money into the bank, central bank. So the type, the quantity and maturity has to be decided. Announcing the decisions of the MOC to the market through the electronic bidding system. So there's a system where you can bid through the electronic system and all decisions to be informed through the bidding system and receiving bids from participating institutions in the case of conducting auction. Then making decisions by the MOC on the auction outcome. Making the standing facilities available to PIs to meet their further liquidity requirements. Now, these are the things which the central bank carry out towards the open market operations. Now then we can further go into the next one. Those are the instruments used under OMO. There are primarily three types of OMO auctions. Now I think what I am now asking is, all these things would be done to achieve a certain goal. What is that goal? To stabilize the coal money rates. To stabilize the coal money rates. If the coal money rates go up, what will happen? It will really enhance the interest rate level, or the rate of interest would go up. The central bank try its best to stabilize the rates. I think the other way, they want to keep the rates at a lower level. There are primarily three types of OM auctions. One is repo and reverse repo auctions. Then outright auctions to purchase or sell T-bills and foreign exchange. Swap auctions. The auctions are on a multiple bid, multiple price system. Participants in the money market could make up to 3 bids at each short-term auction and up to 6 bids at each long-term auction, and the successful bidders would receive their request at the rates quoted in the relevant bid. So the meaning here is, the institutional participants can do this. Now in these auctions, the participating institutions can bid. So, and we call it a multiple bid and multiple price system, because when they do a bid, those participants, each participant can make 3 bids for a short-term auction and up to 6 bids at a long-term auction. So that can be done. So why do you say it multiple bid, multiple price? The multiple bid means any individual institution can make 3 bids and they can give 3 prices. That is why we call it a multiple bid, multiple price system. And that is those 3 bids could be issued for short-term type of auctions. If it is a longer term, it is regarding longer term instruments. Each participant can make up to 6 bids. Right now we will just look at the types of auctions which can occur. Repo and reverse repo auctions. These are conducted either to inject or absorb market liquidity temporarily. If the market is in a surplus, a repo auction is conducted to absorb excess liquidity and vice versa. The auction is on a multiple bid, multiple price system. The amount of the auction depends on the overall liquidity excess or shortfall, prevailing interest rate level, as well as the macroeconomic environment of the country. Now, I think I just want to stress here, now all those activities will decide the interest rate movement. The movement of interest rates would be decided through all these operations. The tenor of the auction is also determined based on the availability of the market liquidity. In effect, under these auctions, IBSL either sells means it's a repo, because purchases, a reverse repo. So when you say a repo, it's a now can you get this thing understood? Now it involves the purchase of one currency against another at an initial date with an agreement to reverse the transaction at a future date and at a specified rate. That is what you mean by a swap. A forex swap transaction is similar to a repo transaction where the collateral of a security is replaced by foreign currency. So it's like this. Now say,
Sir, excuse me.
yeah,
Now,
yeah.
after repo note, which you have just discussed, we lost you. We lost your signal.
Is that so? Oh.
Yes. When you started the repo, we lost signal. Yes.
Okay. I will get it again. Now this is the point where you lose the connection.
Yes.
Right. Okay. Right. Repo and reverse repo auctions. These are conducted either to inject or absorb market liquidity temporarily. If the market is in a surplus, a repo auction is conducted to absorb excess liquidity. Now, repo auction means now they just do a repo auction, and that will result in banks deposit money to the central bank. So that means the excess money in the banking system will come to the central bank. Through that, the excess liquidity might come down. So that means the liquidity position would come down. So that is what happens when they do the repo auctions. And vice versa means if the market liquidity is in a deficit, they do the other way. They do reverse repo. So reverse repo in the sense, the banking system will give them the securities and they will receive money. Through that, the banking system's liquidity go up. Then the amount of the auction depends on the overall liquidity excess or shortfall, prevailing interest rate level, as well as the macroeconomic environment of the country. So this is what happens. The tenor of the auction is also determined based on the availability of the market liquidity. In effect, under these auctions, CBSL either sells, we call it a repo. Now, when they say selling means selling securities. Selling securities means the banks will have to give money. So, in the bank's point of view, it's a deposit. It's a deposit. In the normal reverse repo and repo windows, now what we have a thing called stand-in deposit facility and stand-in lend-in facility. Now, when you say repo and reverse repo auctions here, it is not that repo and reverse repo conducted through the SDFR and SLFR. This is outside that, right? So that is why we call it open market operations. You got my point? Because this is not the transactions done through the repo window. Now, in the repo window, we do it on SDFR and SLFR. Those are the rates applicable, no? But in this repo, reverse repo auctions, the rates are not that. Rates are different. Do you get my point? You get my point? Now here they say repo and reverse repo auctions, no. Now the same thing happens in another way through SDFR and SLFR. SDFR is the stand-in deposit facility. SLFR is the stand-in lending facility. So there you have a given rate SDFR is nowadays it is 5.5. SLFR is nowadays 6.5. That happens. But this repo and reverse repo auctions will be a separate one. It is not the one going through that SDFR and SLFR. Here the repo and reverse repo rates are different, right? You got my point? Any questions on this? Because bid system is here, no? If you have any unclearness or whatever, let me know. Now you all know there's a thing called under policy rate. There's a thing called stand-in deposit facility rate. Now for the time being, it is 5.5 now. And there's another thing called stand-in lending facility rate. It stands at 6.5 now. Under those rates, banks can deposit money with the central bank. And in return, they get central bank securities, right? Or government securities. The other side is the stand-in lending facility. So how do you get the lending facility? They will surrender their treasury bills and bonds to the central bank and get money. That is what you mean by stand-in lending facility. So that was earlier referred to as repo and reverse repo. The particular transaction is referred to as repo and reverse repo. But it is done only at that rate. The rate means either 5.5 or 6.5. 5.5 for deposits, 6.5 for borrowings. Right? But here, what do you mean by repo and reverse repo? It is being done not on those rates. The rates can be bid. There can be a bid for that. Each institution can have 3 bids for an auction. So that is what happens here. Now you understood the difference here. Now this repo and reverse repo are done through the open market operation. Open market operations. These are called open market operations. Is that clear? If it is not clear, let me know.
Sir, now
Yeah.
In banks, the customers can also invest in repos. So
Yeah.
are we relating those to this one, the instrument we are talking here? Is it the same thing?
No, it's like this. What you are saying is correct. But when the customers wants to purchase or sell their treasury bills or bonds, the banks will accept that, but they all will, that stock also come into this, more or less, right? Because the banks, what the banks do is, banks will give them a certain type of a margin. That is what they do. So then it all comes to the same. Now, when you say repo and reverse repo, that the difference here is only the rate, right? Now, as you say, when the customers give treasury bills or whatever, what the banks do, they just get those things into their portfolio. No? So then when they deal with that, they consider them as their portfolio. But when they deal with customers, what happens? They will have a certain margin with customers. That is what they do. Now
So the
that all will same pool, that all will come to the same pool. It's okay.
So the banks can sell this repos to customers with a margin.
Yeah. They can do that. They can do that. But when the banks receive these things, they put those things in the same pool. Because when they deal with other institutions, even though those things are customers, they deal with these things as their own things, right? But when they deal with customers, they have a small margin also. That is how they do it. You got my point?
Yes.
Right. And here it says that in case of repo auctions, when the T-bill stock in the CBSL portfolio is not sufficient, the CBSL uses one of the two options of issuing its own securities called CBSL securities. Now, if they do not have T-bill stock in the portfolio, because the issued T-bills are there in the stock now, but if they don't have those T-bills as a stock, what they do is they issue their own securities. And we call them the CBSL securities. So, initiating bond borrowing program. So they do a program to borrow bonds from some in the market or whatever. So that's another case. So there are two ways of dealing with the insufficiency of treasury bill stock when there's a repo auction, right? So that is what it says. Then you have outright type of auctions. Outright means there's no involvement of repo. It's a normal purchase or sale of treasury bills. It is outright, we call them. And here it says, these are conducted to address the long-term liquidity deficit excesses and therefore to absorb or inject liquidity on a permanent basis. If the market liquidity is relatively a large surplus and is likely to persist for a long period, the MOC decides to sell government securities outright in the secondary market. Now, what is the intention of selling government securities here? Selling. Now, when you say selling, what will happen? The banks will pay money to purchase those things. The monies will go from the market to the central bank. And that will subside the excess liquidity. If it is in deficit, what do? They purchase government securities from the market. And as a result, money will go to the banking system. Right, now the last one would be the forex swap. Now, when you say forex swap option, just look at the mechanism of that. Forex swap is a thing where you have two currencies involved. In Sri Lanka, what happens is it can be Sri Lankan rupees and some other foreign currency, either dollars, euro, or sometimes some other currencies, yen or whatever. So then what happens is when the bank wants to do that with the central bank, we call it a swap auction. There also central bank will have to find dollars or whatever, and they do an auction. So this is also been done in order to maintain the stability of the currency rates, exchange rate also. It's another mechanism to maintain a stable exchange rate. But you can see now what is happening nowadays. That's what I'm asking. Now, do you have any idea of this involvement? Now, can you give an example, a current example for that? It's very, very important to have that ideas. Can you give an example of an institution in Sri Lanka who needs this much of forex swap or whatever? I think it is now a very critical factor in the Sri Lankan economy. Can you just give an example of that nature for the time being? And it is the most critical issue now. Yes, I like to have your ideas on that. Yes. What do you say? Yes, Asanga has asked some question. This IBSL repo, yes, tradable. Tradable, but no, even though we call it tradable, you have to be careful about the securities, underlying securities. You can't sell those things. Underlying securities are there. If you can deal with those underlying securities, there's no issue. But otherwise, you can't trade. I can't really get your question. When you say, is this CBSL repo tradable? CBSL repo means under Oem operations? Yes. Now, under Oem operations also, if you do a repo transaction, what happens is, now the difference here is when you do a repo transaction means you give securities to the central bank and you get money. That is what you mean by a repo transaction. So then there's no way of selling that, no? You get money, no? So you get money with an agreement to pay it back on a particular date. Then afterwards, you might get the securities you have already given to the central bank. So then you can do anything with that. Under the currency of that repo agreement, you will not be able to trade it with someone else. You get my point? It is not necessary. It is not allowed. You can't do that. Now it's like this, no? Now I want some money. What I do is, I will surrender my treasury bills to the other party, to the central bank. Now, as a result, the central bank would give me money. That is the repo transaction, right? Then it doesn't end there. I want to pay it back with some interest. Another week's time. Now, till that time, I can't do anything with that. No. Now, after I settle it, I will get the treasury bills back. Then I can do anything with that. Reverse repo also the same, no? When you say reverse repo, in the point of view of a banker, the reverse repo is a deposit actually. Banker deposits money with the central bank, then the bank will get treasury bills in return, right? But during the currency of the treasury bill, because you have already paid money to the central bank, no? Right? So that is your deposit. But for that you get treasury bills to you. So those treasury bills, I think, provided that if you can give it back on the maturity, you can do something during that time if it is a long period. Otherwise, you can't do that also. You got my point, Asanka? Now it's like this. Now say you got some treasury bills under your reverse repo agreement, and you paid money to the bank, central bank. So I am referring to the when I say reverse repo, these point of view of the bank, no? Right? Not the central bank. Normally, when you say a reverse repo is the lending done by the central bank. So that is how we normally refer these things, right? reverse repo is lending done by the central bank. So when the lending is done by central bank, it is a bank's deposit. Bank will deposit money to the central bank. Then the bank will get these securities. And there will be a particular day on which you have to surrender those things when you receive, when you give money. When the money is, no, this is actually now, when you say central bank reverse repo, it is a lending done by the central bank to the bank. So the monies will be received by the bank, normal bank. There's no question of selling the repos or whatever. It is money they receive. But when they pay back the money, they would get the securities again. Afterwards, they can do anything with those securities. Even the other side also the same. Now, when you do a repo, when the bank wants to have a repo, so then they borrow. It is in the point of view of a central bank, it is a reverse repo for them. When the bank borrows, bank has to surrender the treasury bill to the central bank. Then after paying money, only they will get back the treasury bills. Okay, that is how it happens. So whatever the case, when the agreement is in current form, you are not in a position to deal with that treasury bills or treasury bonds. Because even sometimes you might have given money on some treasury bills. Those treasury bills also, you can deal with that till the maturity date only. So on maturity date, you have to surrender those things. That is the issue. So I think Asanka has got my answer. Is that okay, Asanka? Right. Now then we are talking about this forex swap. When we talk in terms of a forex swap, I think that's what I'm asking the question. And what is that? What is the example you can give in current perspective on forex swaps? Yes. Yes, Chalana Asiri.
So, as a country, we took swaps from two countries, Bangladesh and China, to settle our dues these facilities. So I think it's an exchange of loan installments or interest portions, kind of things.
Yeah, of course. Now I think that is the issue now. And in what is the Sri Lankan institution where the highest involvement with those forex swaps? The Sri Lankan institution, the corporate.
Sri Lanka Petroleum?
Yeah, Petroleum Corporation is the main institution where they deal with such type of swaps or whatever. But those swaps on behalf of CPC, the banks have to do. On behalf of CPC, because they need dollars now. In order to give them dollars, the banks deal with central bank and get these swaps done. That's how they do it. I think you got my point, no? That is the way. Not only for one bank. I mean, even the central CPC can deal with their bills, and they need foreign currencies to pay the bills. So to get the foreign currency, they just engage with some bank. That's what I think I have seen some monetary policy condition also there. They say these import bills have to be dealt with by not only the Bank of Ceylon and People's Bank, other banks also should come into that. I think there's a particular, I think I can say that is also coming to the OMO, because the forex swaps has to be executed. in that case. I can show you that also. In the earlier document I just showed you. Wait, I see. Not that. Anyway, there's another. So under open market operations, they deal with these foreign currency swaps also. And that press release, I just shown you a press release earlier. Can you remember? Yeah. Can you see the press release on the screen?
Yes.
Can you see that?
Yes.
Right. Now under this press release, you can just see here. Monetary and other policy measures are expected to strengthen the macroeconomic stability. Now it says increase the standing deposit facility rate and the standing lending facility rate of the central bank by 50 basis points each to 5.5% and 6.5% respectively. Then distribute the financing of essential import bills of fuel for fuel purchases among the licensed banks in proportion to their foreign exchange inflows. Now just look at it. Now this has a big implication on forex swaps executed by central bank, because the banks have to just deal with central bank to have these things done. Now, if the banks don't have a foreign exchange inflow, then they will be in trouble, right? Now you got my point. Now I think there have been several other measures that have been taken to just enhance the foreign currency inflow to Sri Lanka. That is also coming under policy measures, right? Right. If you need, I can just explain it on the board. What do you mean by a forex swap? It is like this. I will show it on the board. I'd say on 1st of January 2022, right? So this is the first day. And then there's another day, you can say on 14th of January 2022. These are the 2 days. On first day, say there are two, say Bank of Ceylon, IBSL, right? Now the particular shop is operated with Bank of Ceylon and IBSL. And here, Bank of Ceylon receives, say, $100 million, and Bank of Ceylon paid the equivalent amount of rupees. So equivalent amount of rupees would be 100 million is 10 billion. About 20 billion rupees, right? 20 billion, that is 20,000 million rupees. Now the swap transaction takes place today, right? Now,
Sir,
yeah,
we are getting a mirror image. What you are writing is, we are seeing it other way around. Mirror
fair.
image. Yes.
මේක මේකේ මිරර් වෙනවද ඔයා බලන්න මේ මම බෝඩ් එකේ ලියනකොට මේක
Okay, sir. Okay. We can't hear you, sir. Sir, we can't hear you. We can't hear you.
right. Now, on the first day, Bank of Ceylon will get $100 million from central bank, and central bank will receive 20,000 million, that is 20 billion rupees from Bank of Ceylon. So that is the first transaction. Now, there the rate has been decided. Rate has been decided, right? Now, when you say swap, but next time, the Bank of Ceylon has to pay, because since the Bank of Ceylon has received this amount at the beginning, after 14 days, this $100 million to be paid back to the central bank by the Bank of Ceylon, and central bank will give back 20 billion, but it's not 20 billion. There's an adjustment for the first, right? I think you got my point. So that is what you mean by a forex swap. I have given it in a very simple manner because otherwise you might have some confusions. So as it is, the swap means a type of an exchange. Now, when the banks need foreign currencies, what they do is they go to the central bank and just initiate a forex swap. Now, at the first initiation, they get dollars, right? But in return to that dollars, they have to pay rupees to the central bank. Now, say I have just imagined that $1 is worth 200 rupees. With that, the $100 million, if the Bank of Ceylon get from central bank, Bank of Ceylon has to pay 20 billion rupees to central bank. But this has to be reversed on 14th. That is what you mean by the swap, no? Now, when it is reversed, is $100 million to be paid back by the Bank of Ceylon, but the central bank would not give them 20 billion. They would give them a lower amount. So that is the cost of the transaction. Yeah, the rate means this. That's what I told you. The rate can be different. Rate can be different. That difference is the profit of central bank. Two different rates that has to be taken into consideration. But the volumes are same. Volumes are same. Because here the main volume is the $100 million. It doesn't change. Only the rate changes. That is what you call soft rate. Got my point? That's what I told you. Because when it is done the next day, the 100 million worth things would not be received by the bankers now. So they just get it reducing the premium. After reducing the premium only they will get it. For example, you have paid a particular amount to central bank to get $100 million, is it? If you get the same thing again, then there's no transaction cost or whatever. No? But you have to give them the same amount of dollars. But you will not get back the same thing. Now, for example, say now the central bank only reversed after getting $100 million. They would just say 19.8 billion. Say there's a 200 million profit for the central bank from there. That is the rate. Soft rate is there. Is that clear? Is that clear? I am just giving you a very simple form. Now that there will be rates applicable, that's okay. But what I am telling you is the ultimate thing. What would happen? Now, for example, now say the Bank of Ceylon has a dollar requirement of 100 million today, 1st of January, right? They want to make a bill payment, right? For the bill payment, they need $100 million today. They talk with central bank and they just say, we will have a swap, dollar swap. And the central bank, they agreed with central bank to settle it on 14th of January. And as per the 14th January term sheet, what they should do is, they should pay back $100 million with some transaction cost. I mean, that cost also to be there. But that cost has to be borne by the bank. Therefore, what would happen is, the central bank would not return the same 20 million again. They would return only 19 billion, 0.8 or something like that, reducing the charges and those of cost and all that. Got my point? That is how it happens. Is that okay? But there's another thing here. Now, in order to pay back $100 million, Bank of Ceylon would have to get 100 million from some other place. $100 million from some other place, no? They would get a loan from a bank, a foreign bank. That can be arranged. Or sometimes the foreign remittances or whatever comes to the bank would be taken as 100 million. I don't know. That 100 million, I mean, collecting 100 million would be a big challenge these days. Is that clear? That is how all these transactions would happen. Forex swaps are that type of things. But in Sri Lanka, what happens is now all the swaps deal with the currency and the Sri Lankan currency. But in the international market, it would have a different way. What is that? Now say for example, now I need to pay sterling if I do a transaction with United Kingdom, UK. Sterling pounds I have to pay. But in my bank's liquidity level, I have more dollars with me than sterling. What I can do is I can go to a bank and just ask for a dollar sterling swap. I will pay dollars and that bank would pay sterling at the first day. On a second day, second time, or we call it the second leg. On the second leg, they would have to pay back what they have taken. And the other bank has to pay back what they have taken. Say for example, now, since I need to make a payment to British bank, I need sterling today. What I did was, I just had a swap with, say, Barclays Bank. I have dollars with me. I paid them dollars and I got sterling today. That sterling when I got, I just paid it to settle my bill. But after one year or sometimes 6 months, I have to pay back that sterling. Then I will recover dollars. That's how it happens. Then I have to pay the interest for them. Since I got sterling, I have to pay them sterling interest. They would have to pay us dollar interest. That's how it happens. Is that clear? So the same thing happens in Sri Lanka also, but the difference is it is with Sri Lankan currency with another foreign currency, always. Not two foreign currencies. Sri Lankan forex swap is like that. Is that okay? Yes. Right. I think with that, I think that is normal situation. Not a big thing. Right. But now when you read it, you might get the idea. So I will read it for you. The forex swap involves the purchase of one currency against another at an initial date with an agreement to reverse the transaction at a future date and at a specified rate. A forex swap transaction is similar to a repo transaction where the collateral of a security is replaced by foreign currency. I think this explains the situation. A buy-sell swap injects rupees to the market and a sell-buy swap absorbs liquidity from the market. A buy-sell swap. Buy-sell means now rupees being given and dollars being bought. Sell-buy swap absorbs liquidity from the market. Now, I think these things can be explained in normal form because you have to see the cash flow. Now, you need to check how the cash flow comes to the bank, cash inflow and cash outflow. At the first instance, since the Bank of Ceylon wants dollars, the Bank of Ceylon will have a dollar inflow at the first leg. And central bank will have a rupee inflow. then the rupee liquidity goes down from the market because the bank has paid rupees to the central bank in order to get dollars, no? So then what will happen on the reverse or on the second leg? The bank would receive rupees and that would be injected to the market. And there will be excess liquidity at that point. Bank would have to pay $100 back to the central bank. Is that clear? But the problem here is, even though we do these things, there can be several other complicated transactions involved in this case, because in the bank also there can be several other transactions. Because the bank deals with several other international banks, and they have several cash flows from those banks. Right. Any question? Any type of clarification also? So then, if I put it in a brief format, under the open market operations, you will have repo and reverse repo auctions. Then you might have outright type of auctions. Outright auctions with government securities. Then you have forex swaps. These are the three instruments which are in use in operations of open market. Under the open market operations, the intention of the central bank is to stabilize the call money market and the foreign exchange market. Right. I will ask a small question now. Now say, the bank, say a particular bank, I just want to, I don't want to tell the name of the bank, but I can say just ABC Bank. Now ABC Bank had a, no, it's like this. The monetary committee of the central bank observed that there's excess rupee liquidity in the market. Excess rupee liquidity in the market. And they decided to do some open market operation. Now they realized that the market has excess liquidity. Now I think my question is, what should the central bank do in this occasion after understanding the market has an excess liquidity? What should they do? It's a simple question, but if you understood the contents which I just explained, you should be in a position to answer that question. I will give the question again. The monetary committee of the central bank, through their experiments, through their surveys, they found that the market has excess rupee liquidity. And they decided to engage in open market operations in order to bring down the higher liquidity levels. What should they do? What should they do? I ask only one. There can be several things which can be done, but I ask only one. Yes. Outright repo. Yes, I think the Chalana's answer would be correct. Sell securities. Outright repo. Outright repo. Yes, correct. Samit correct. Samit also correct, because when central bank did the outright repo, what happens is central bank will have to sell securities. The monies will come from banking sector, banking system, and the excess liquidity will go back. Forex swap also particular, yes, it is also a situation. It is also correct. It is also correct, because when you have a sell buy forex swap, buy sell, no, you buy foreign exchange, no. In order to buy foreign exchange, you need to have rupees. We call it buy sell. Buy sell forex swap. Asanka, it should be buy sell, because you buy dollars, no. In order to buy dollars, you have to give rupees to the central bank. So the correct version would be buy sell forex swap. We call it buy sell forex swap. Buy sell means at the beginning you need to buy foreign currency, sell rupees. That is what it means. Okay, I think you just shown sufficient understanding about these things. It's okay. And in addition, now I think this buy sell swap injects rupees to the, now here it says injects rupees to the market, and a sell buy swap absorbs liquidity from the market. Sell buy. Yes. Sell buy.
So here
Oh,
selling.
right. Okay. Right. I think you are correct. Sell buy forex, yes. Sell buy means you sell rupees, buy dollars. Yes. Correct. I think you are correct. Because it should be like this. Because you buy dollars, though you buy dollars, you can say sell buy. Sell means your currency you sell. Rupee selling. Buy in dollars. When you say rupee selling, you just the rupees go out from the bank. Rupees go out from the bank. Correct. Now, I think you all can understand the meaning of these first leg and second leg, no? So in my example, I told 1st of January, that is the first leg of the swap. January 14th, it is the second leg of the swap. Now, in the first leg, it would be a sell buy. And the second, because the dollars buy, you bought dollars, no? Then the second leg would be buy sell. Second leg would be buy sell. In a buy-sell stock, what happens is the rupees will be injected to the market. Anything else you need to clarify on this? Now, this particular thing is the important thing where we have to.
So you always tell it in the point of central banks view, isn't it?
Yeah.
So when you say sell, buy.
Yeah. Anything else you need to clarify? Shall I go to the press release again? Right. Now this is another document. Can you see that? Can you see it on the screen? Another press release? Overnight money market transactions. This is issued on 28th of January, yesterday.
So what do you mean by overnight money market?
Overnight means now when the banks come into the transactions, they need to sell or buy, or you can say borrow and lend overnight. Overnight means only for 1 day. Now if I borrow today night or today, I have to settle it tomorrow. That is what you mean by overnight. Overnight money market transactions is that type of transactions. Overnight means only 1 day. So for example, now I want to my reserve is so much. Say I have to maintain a reserve of 10 billion, right? But today I have a deficit of 1 billion because my reserve has come down to 9 billion. Now what I have to do is I have to go to the call money market, overnight market, and just borrow 1 billion rupees from the market. So that is what you call overnight. It's only for 1 day. So I have to settle it tomorrow. That is what you call the overnight market. Now you can just look at the overnight market rates. Weighted average rate, call money market, it is 6.48. Repo market, it is 6.49. Right? Repo market is also, now you can just look at it. So it's really a I don't know. It's not that surprising, but it's like this. Now you can see the 6.5 is the standing lending facility rate also. So therefore, the call money rate has not gone beyond that. So that's a good indication about the market, because the lending rates are being controlled at 6.5. The call money rates also have not gone beyond that. You just got that point. And you see the call money market has a gross amount of 45 billion, 45.7 billion. In the repo market, it's only 12 billion. Now you can see the call money market has a lot more transactions than repo market. Lot more transactions than repo market.
So what is the reason for that?
Because in the repo market, you need to have securities. If you do not have securities, you can't do repo transactions. You need to have enough securities, no? Treasury bills and bonds you need to have. If you do not have treasury bills and bonds with you, you can't do repo transactions. All money is just to borrow money. There's no need of government securities as collateral. You don't need that. So therefore, the tendency is to have more transactions, volume in call money market. Got my point?
Yes, sir. Yes.
Then you can just look at open market operations. 70 billion offered under open market. Auction is 28 January, that is the date. Date of maturity is 35 January. So it's only for 3 days they did it. Bids received. 66 billion worth of bids received. The same amount been accepted. Rate, minimum rate is 6.48. Maximum rate is 6.499. That is almost 6.5, is it? So this is another development you can see. Still, under open market operations also, it had not gone beyond the standing lending facility rate. It is just below that. So that's another, I think it's a plus point for central bank, I think. Then the use of the CBS standing facility. Deposit facility being used by 56 billion. Now you can see lending facility being used by, I think, the billion, 581 billion, right? The big amount. Now you can see the position now. Banks are really borrowing, no? All banks are borrowing. That is what it means. Now, by this use of the CBSL standing facility, that means now can anyone tell me what can you gauge from this? What is the understanding you get through these figures? I think they borrowed more than 10 times or 11 times what they deposit. So what is the meaning of that? What type of indication it gives? Yes. What type of an indication it gives? Yes, I think that is an easy argument. What do you say?
So if we have historical figures for this, we can get an idea whether this.
Very good, very good. Yes, I will give you. I think there's another chart with me. I can give that also for you. But I don't know these open market operations I have, but other things I have. These policy rates I have. I can do that. Yes, market has a liquidity shortage. Yes, Samit's comment is correct. Or deficit in liquidity. Yes, that is also correct. Asanka also said that. Yes, good. So these are the indications. So for an investor or analyst, these things are very important because you can get an idea of the interest rate movements in the future by looking at that. So for an investor, the interest rate movement, the term structure, whatever is very much important. Because that gives the investor or the analyst a very clear view of the market. Right. With that, we can have a break, and we will just start it by 3:50. Right, coming back to the session. We can just go into the figures. Can you see this, the website? Colombo Stock Exchange website is now on the screen.
Yes, sir.
Right. So today what I want to tell you is, now I just access the website on the screen, and then you can familiarize yourself with these things. Now when you just go into this CSC website, you can have the details on equity market, debt market, then you have the over-the-counter platform also. There you have different transactions. Then you have corporate announcements and publications. There I just want you to just look at the market, and there you have under the equity market you have trade summary, detailed trades, daily market summary, and all that. And I can just say, I can start with the trade summary. Now under the trade summary, you have it on alphabetical sequence, the companies. Now in this particular trade summary, you can see Advanced Electricals, Advanced Finance, Access Engineering, ACL Cables. Likewise, now you have several companies here, and their symbols also been given here. ABAN, FSL, AEL. Likewise, you can see the types of codes given to different companies, and there can be several things which you can look at. Now, in order to get some information with regard to a certain company, you can get the share volume transacted in particular day, and the trade volume. Trade volume in the sense, now how many packets been transferred. Previous close is 210, open 210, high 210, close 200, and that is the lowest one, and it last traded was 201.50. Now the change being given as 150 minus, and since of that the change percentage is given in red. If the change percentage is given in red, that means it's a decline relative to the last day. If you get a green type of percentage change, that means it's an increase relative to the last day. Now here Advanced Electricals had a decline relative to the last day, last business day, and Advanced Finance also has a decline. So that amount of decline is minus 0.74. And Advanced Finance also had a minus 1.9 decline. And if you go to the Access Engineering PLC, there you get a 1.17 increase. Next one also 1.8, ACL Cables 1.88 increase. Now these are the information you can take from that sheet market, this thing. And if you want to get more details, what you can do is you can just click this, and after clicking that you will get this information. Now just look at those things. This was the last traded price, 201.50. The share, one share was traded at this amount, 201.50, and Previous close was 203. So now we can just see why this has been taken as minus, because earlier close was higher than the latest close. Latest close was 201.50. Earlier close was 203. So there's a 150 difference, decline. And when you say turnover, rupees so much, that is the turnover for the day. Last business day, now last business day was 28th of January. Share volume means number of shares transacted. Trade volume means number of trades taken place. Say buy-in and sell-in or whatever. 10 trades took place. Now the day's price range is this. They started with 210, but it closed with 200, but not closed with 200. It closed with 201.50, but during the day there was a price 200 intraday. Now, what is the meaning of market capitalization? Market capitalization is the number of shares multiplied with the share price. Then you get the market capitalization. And here you get market capitalization as a percentage of total market capitalization. What do you mean by total market capitalization? Now, there are about 237 or so companies altogether. And all the companies' market capitalization being taken together. And it is added up. Now, when you add it up, you get the total market capitalization. So, now here the 0.02 is the market capitalization of Advanced Electricals in relation to the total market capitalization. So that is the figure given here. Then you have beta value. Now beta value, there are two beta values given here. One beta value is given in respect of the all share price index. And it is given as of fourth quarter of year 2021. So this was the last quarter, right? As for the last quarter data, the beta value of Advanced Electricals is 0.25. And if you take the other beta value, that beta value is taken against S&P SL20, that is Standard & Poor 20, or that is also taken on behalf on account of the fourth quarter of 2021. That is 0.61. So now by looking at these indicators, you can get a certain type of idea about this company. Now, this company's turnover is so much for the day. Share volume is so much traded. There have been only 10 trades took place on 28. And if you take the market capitalization as a total of the total market capitalization, it's a 0.02%. It's not a noteworthy type of capitalization. That is what it means. Now you can just go into more details. The company profile is given here. And if you want to get more details, you can get charts here. The performance. Now 52-week variant performance, you can say get data. Right. Now the thing is, now I have just gone to the normal access rights, and I might not be able to get these data. Anyway, it's okay. I just want to show you the way it can be used. Right. So, but what we can do is we can get the financials. Right. We can get the financials of this company by looking at this. Annual report is ready for 2020-2021. So this is the last annual report available, and it was uploaded on 30th August 2021. So if you want, you can go to the annual report and just look at different details of about this company. Then there can be videos, announcements, quotes, articles, AGM, AGM calendar, connect with IR officer. Likewise, all these things are there. So you can see how you can get the information from this type of a website, right? In my opinion, the most important type of indicators you can get from this website is the return. If you have the return here, you can, but only thing is now here you get only a daily type of a thing. But if you want to get monthly or quarterly things, you would be in a position to get into another link and get those details, right? Anyway, now here you have two market betas where you get in relation to the SPI and in relation to S&P 20. Now, of course, now I am asking the question from you. Now, if you look at the beta of this company, this is Abans Electricals Private Limited. By looking at the beta values, beta value in respect to the ASPI, that is all share price index, and the beta value in respect to the S&P 20, SL20, what type of a comment you can make on this company, this company shares? These are the practical things which you need to understand, and because we have gone through and we did several calculations to calculate the beta. Beta is the systematic risk or indicator of systematic risk. When you get a beta value of this nature, what type of a comment you can make? Right. Now you know what is the meaning of beta value?
We can comment about the aggressiveness of the.
Of course, yes. Now, how aggressive this company is?
0.25 means not that aggressive.
Yeah, because the determination is if the beta value is less than 1, which means it is a defensive type of a stock. Aggressive stocks are really, the beta values should be higher than 1. Now, the meaning of beta value higher than 1 is if you get the beta higher than 1, which means it is more active than the overall market. So then it's an aggressive one. But if you get the value like 0.25, it's a more defensive, or you can say rather defensive type of a stock. But if you take the other beta, that is in terms of S&P 20, it is 0.61. It has a little higher value. But only issue here is the S&P 20 doesn't represent the total market. That is the issue. So therefore, we need to focus more on the beta value, which is relevant to the all share price index than the S&P 20, because it gives overall market indicator. We can just consider it as an overall market indicator than S&P 20. Okay. Anything else you can say about these things by looking at this sheet? Anything else? And if you need to get some articles, so say there can be some articles given, so that also can be you can read those articles. So I'm just showing you the types of information you can gather from this type of websites. And this security has the international code also. ISIN is that LK0001N0004. So that is the security number. The stock is given this code. Advanced Electricals Private Limited stock is given this code. Okay, we can go to another company. Say, now we will go to a company which has a positive change in respect to the yesterday or day before, 27th. ACL Cables. Right. The share price is 122 and it has a growth of 2.25 and percentage 1.88%. And the price range was 124.50 to 160. Earlier day it was 1975 and it came down to 122 last. There you see the SPI, with regard to SPI, the share value, beta value is on 0.76 and against S&P it is 1.44. So, right, now I am just asking you a question. What comment you can make on this? What type of comment you can make on this? And you can see, if you look at the trades and all, this is a more active company. And there have been 729 trades taken place in the day. And share volume is, share volume in the value, 2,224,059, that is the share volume. And the turnover, now share volume in the sense the number of shares. And turnover means the total of transactions value, 266,060,752. That is the turnover for the day. And its market capitalization is 29 billion. And it's 0.51% of the total market capitalization. So if you just look at it in relation to the earlier one which we have gone through, that is Advanced Electricals, and this company is a more active and more valued company, I think. It seems like that. Anyway, so in that context, what can you say about these betas and all? Yes. And you can get some idea, company profile also, you can go through here. Now it is in the sector, manufacturing and marketing of cables and conductors. Now that is the sector, manufacturing sector. And industry group is capital goods. Founded in 1962. It was quoted in the Colombo Stock Exchange in 1st January 1976. Its financial year ends in 31st March. And all other details are given here. All the key executives' names are given. Board members' names are given. I think if you are a bank, you should be in a position to go through this website and collect most critical information from this website. The beta values you can get, company profile you can get, even charts. They are also, I think I may not be in a position to get the details of the charts.
So if you go to Barron's, you can get the charts. All the charts are there.
Where?
Barron's.
Balance.
Barron's, yes. BARRONS. Barron's.
Barron's, right. Okay. Right. No. I just want to show you now. This site just got a normal login, and this is not possible for that. But anyway, there can be other ways to get it, and there's another one called financial. The financials can be taken without any issue. Right. This annual report can be taken. It can be downloaded even. When you say other reports, no PDF download here. So likewise, there can be several restrictions if you just log in with the normal way. But anyway, I think that particular information is sufficient. I think for our purposes. Right. Now we can see the any other company. Say, now we can go for Amana Bank, Alumex, Alliance Finance. So we can just go and check Alliance Finance. Yes, they are also, the volume of trade is low. Even the turnover is 3 million. Market capitalization is only 0.08. And the beta value is also 0.17 and 0.13. There the S&P 20 is low than the all share. So that's a peculiar site where the other companies we have observed that the S&P 20 related beta is higher. But in this case, the S&P 20 related beta is lower in this case. Okay, right now these things actually, then we can have another type of information guideline here, or information source here. So we can just go to that. Yes. Now under market, you get the publications. There you have Csc daily, Csc weekly, Csc monthly, Csc quarterly, and so on and so forth. So I think the most most useful one would be Csc monthly. I think we will see. We can have the monthly report for December 2021. Now after the end of January only, we can get the January month report. So now it is available only the last month's report. So what you can do is you can download that if you want. So after downloading it, you can go to the different information sites where you can get the information. So can you see the Csc monthly? Can you see it on the screen? Yes. Can you see?
We can see. Can you zoom the figures, sir?
Wait. It's I mean, all right. I can zoom it. Is that okay?
Yes. Yes.
Right. Right. Now, in this report, the most important things I can just show you. I think earlier also I just shown you the monthly CSC monthly report. Now you can just look at the two things here, ASPI and SNP. Now just look at it. This is the month of December 2021. And just look at the change of indices. And it was started with 11,440 cents 53. And it closed at 12,226.01. So the change is taken as a percentage 6.87 per month. 6.87 per month. Now, if you look at it, and then you get the other side, that is in relation to the S&P 20, there the starting figure was 3,875.96 and the closing was 4,233.25. There the percentage change is 9.22. Now, if you look at these things, if you want to get some market return indication, the market return for the month of December 2021 is 6.87% in relation to the ASPI. In relation to the S&P 20, the market return is 9.22%. So you can see the market return, how the market return has a premium against the risk-free rate. What is the risk-free rate for month of December? Can you just imagine? Can you imagine that risk-free rate? Yes. Now, treasury bill rate, are you in a position to get? We can actually, we can get that. Right, anyway. Now, when you go to the return, we call it total return indices. And returns, if you take the returns into consideration and if you go for that index, there the index started with 15,366.66 and it ends with 16,423.75. There the change is 6.88%. Now you can see the difference, 6.87, 6.8, 9.22, 9.27. Now these two are more or less similar. More or less similar. But I think if you want to get the return calculation through this particular sheet, you better go to the ASTR, it is all share total return index. That would be the better one. Now, this also, if you don't have this, you can just get this. But if you have the total return index here, so you should go to the total return index. That would be better. That would be more correct or more accurate. Price earning ratio. This is the price earning ratio. Now just look at it. But here debt trading statistics are also given. Now you can see the weak nature of those transactions. The corporate debts are not been transacted so much. But only one trade has happened. 252,000 debentures being traded in one packet. The turnover is only 26 million something. And government debt not been indicated here.
So what do you mean by government debt?
Government debt means
Trading.
yeah, those government debts means the government securities most of the time, government security, but it has not been given here. So in other place it has been mentioned that the government debts been not mentioned here, because as a practice only they just put government debts, but they have not mentioned the amounts there. But they are the only corporate debts being taken into consideration. It is not given here.
Right. The earlier page on top of the page, can you go to that page? The earlier one, previous page number 1.
Yeah, this not.
Turnover.
Turnover.
The turnover, if we take 2020, it's 67 billion, is it?
A billion, yes.
Yes. So in 2021, it's 149 million. Is it now? Is it the reason the fluctuation of interest rate or the reduction of interest rate to investors to come into share market?
Of course, that is one reason. Yes, that is one reason, because the thing is now when people try to invest in normal type of securities, the risk-free securities, they find that the interest rates are very, very low. And because of that, there's an incentive for them to go to the equity market. Now, they just expect from equity markets a higher return. And it is risky also. And since it is risky and expectation of higher returns, they go to the equity market for investments. That is why the volume has increased so much, because the government been able to maintain the interest rates at a very low level, and with that they have been able to attract so much of investors to the stock market. That is why the turnover has gone up to that level. That is about, say, the turnover has been tripled, it has been more than doubled. So therefore, that's the main reason. But in addition to that, I think
now, sir, if you take ACL cables, Abans Electricals, and if you compare it with banks, right? The amount of increase in the share price, it's very low in banks. The change is very different in banks. What is the main reason for that, sir?
Yeah, that's a very good question, I think, because I really appreciate your observation. Now, the reason may be the banks had a difficult period of time, because they had some in terms of foreign transactions, banks had a very difficult time because they didn't have liquidity on foreign currency. That is one side. Even the domestic currency also, the liquidity situation of banks been deteriorating throughout the time. And they are really working hard to just deal with those things. And that is why the banks didn't have that much of a growth during that period, even the stock prices, because I think the market has market has contemplated or expected all these problems. I think because of that, the market sentiment has not gone up, and the banks had a hard time. I think the main reason is not only the corona issue. I think the economic situation, also the government policies and all sort of things being taken bad shape. Because of that, the banks really faced with this type of hard time. I think the other thing is even though the banks give a volume of loans, it is very uncertain that the recovery or whatever with these downturns and all. But even it's only a demand side, the supply side issue. But there's no financial issue per se now for the time being. But with that supply chain issues, the banks also had that issue, because when you say the supply chain, even the job, the people who work in the banks also, they had some issues, and they are not in a position to take all of them into the work schedules and all. So that also been issues like. Anyway, it is visible. It is visible. It is visible in this information. So if you go to the sector-wise type of things, then you can just imagine those things. Now here the equity trades being given, then number of shares also given. And it says the number of days, the market days during this month. There are 23 days in the month of December. Earlier month it was only 20 days. So likewise you can see the number of days also. In the year 2021 there are altogether 240 days. But in 2020 there are only 209 days. Now here the government is being excluded here. That's what here it says. No government that's been taken here. Now you can just look at the next page. There you get all your different transactions or different indices. Now the sectoral type of indices are also maintained. In SPI, the SPI is being put into components like bank, finance, insurance is one component or one sector. Beverage, food, tobacco is another component. Chemicals, farms, another component. Construction, engineering, another one. Diversified, footwear, textile, healthcare, hotels, investment trust, IT, land and property, manufacturing, motors, oil palms, plantations, power and energy, services, stores, supplies, telecom, and trading. Right. Now, these are the indices. Now, the index in relation to the bank, finance, insurance started with 25,188.27. It closed at 25,000, same. So you can see there's no change. No change. Index has not been changed during the month. That is what it says. So that's the type of situation where I think peculiar situation. No change. No change took place. S&P 20 also the same. And you can just see the how these changes been taken place. So it started with 11,494,0990 and going like this. So you can see the different changes. And there's a chart given. SPI movement in this month of December. S&P movement in the month of December. Now you can see it started in 10,000, say 11,500 or so, no? Yeah. And it ended here, somewhere here. It is passing 11,700 or, yeah, just below 12,700. And S&P also starting with 3,900 and it ended in between 3,900 and 4,400. Then the foreign trading statistics are also given. And all the final date in the month, market capitalizations are given. And the sector also given here. Changes in board of directors also given here. Company registers. And yeah. And there's one with regard to the dividend announcements. Right, you can just look at it because the thing is now we have done a stock valuation studies by going through the dividends, and we call that methodology the one-stage dividend discount model. That is one, and we went to the two-stage model also, and all these times we did the valuation of a stock by looking at the dividends. And there have been several assumptions on these dividends. Basically, we assume that the dividends growth, there would be a growth, and that growth is a constant growth in order to be simple. But what happens is, in reality, we may not find any organization with the constant dividend growth. And in some occasions, the dividends are being paid at a very high rate at the beginning. And in a case where the dividend rate, growth rate is higher than the rate of return, capital rate or whatever, WACC, weighted average cost of capital or whatever, then you can't apply the one-stage model to calculate the stock price, then you will get a minus value for the price. So all these conditions will be there when you do the stock valuation. But whereas you can just look at these dividend announcements and see what type of what are the types of percentages they declared as dividends. And they are the details are given, the name of the company is given, and the rate of dividends given, or in rupees they have given the dividend per share. So either the dividend can be taken as dividend, or first dividend, second dividend, or last final dividend. So that way the particular amount is given. So that was recorded or informed in 30th of November, and in some cases someone been given on 15th of December, but another 2 or 3 days time they just recorded as a dividend declaration date, but the payment is made on another day. Right, now you can see for different companies what are the types of dividends being declared. Expect corrugated cartons, now they declared a dividend of 20 cents per share, and this is taken as the first interim dividend. And there can be several other dividends. Csc also the first dividend, that is 10 cents. Cargill Ceylon Limited, they declared a 2 rupee dividend per share. So now you can see what is the percentage here. So how do you do that? So you can just get the average price of that share to see what is the percentage of dividend. Ceylon Beverage Holdings, that is 6.31 is the amount of dividend, that is the second interim dividend. Now when you say interim, that means there can be another dividend, or another 1 or 2 dividend cash flows. That is what it means. Now you can see the dividends being given different values. Valuable given 150. Central Finance, Diploma Ceylon, they gave 15 rupee dividends. So this is a critical type of information sheet where we can get an idea about the rates of dividends being paid. Now there's another thing called watch list, and those things actually you all know. Those are the different companies with some issues. We call it watch list. I think now these things actually very much important for the banks, because if some customer or some counterparty comes to the bank for a loan or whatever, so you can just look at this stock market publications and see whether they are in the watch list. So when they are in the watch list, the meaning is they are with some trouble. Or you can just look at it. Input Finance, you can see it is in the watch list. Anilana Hotels in the watch list. Blue Diamonds Jewelry, that is in the workplace. Now, these are the companies with some issues. Multi-Finance, City Housing, Adam Capital, Ceylon and Foreign Trades, Lucky Lanka Milk Processing, Paragon, Office Equipment PLC, MTD Workers, Ceylon Printers PLC, Adam Investments, Swarna Mahal, Lanka Cement. So these are the information which we need to get in terms of credit analyst or whatever. So you need to get these things also. Anyway, now we can go to another. Right, if you want to get CSC quarterly, there you have this is the quarterly report. Now in the quarterly report also you get some information, but I think in terms of information, the most critical one is the monthly report, Csc Monthly.
So you can't hear. So we can't.
An issue.
Voice is not clear.
Is it okay now? Is it okay that the voice clear now? Is it okay now? I think, am I clear now? Yes. Right, now we have gone through several data sources, and we have been able to get some information from those data sources. And finally, I just went through the quarterly statement of Colombo Stock Exchange. And it gives you a certain wealth of information. Since you told me that I'm not very clear, anything, is it okay now? Now is it okay? Can you hear me, all of you? Can you hear me?
Yes, sir.
Right. Right. Now you can see the screen, no? Right. Csc quarterly. Right. Now when you get the Csc quarterly, then you get these data, domestic, foreign, purchases, sales and all. And it is given for the quarter, the daily turnovers average.